Hello guys, as we have seen yesterday, we have spoken about earning news in general. We have seen how this is done and how the traders react to the news and what will happen to the stock when things begin to take action. Because understand that after the market close, in general, most of the time you see that traders activity goes down. Okay, it means it goes down. A lot of people, they sell. It means during the day they buy some stocks, and some they wait until the end of the day and then they sell before 4. Now that's why you see a very large drop to the volume. Because what is volume? A lot of people, when they see volume, they don't understand that volume is two things. Okay, is buying and selling. But they don't show you, especially when you are doing level 1. It means when you see just a bid, one bid and one ask, you don't see how many are selling and how many are buying. Okay, and this is a trick. You don't know in general. You don't know in general the information, because if you know the information, you will get an advantage all over the other traders. But this is you can do it, but it's not efficient or it's not effective 100%. Now, if you go to, for example, level 2, you can see who is buying and how many shares are buying and how many shares are selling. But the problem, they don't give you, let's say, the true information in one number. For example, they say to you, they will show, let's say 100,000 shares bought, 20,000 sold. Now what does it mean? It means there are more buyers than sellers. It means the people who are buying are more. So what does it mean this? It means that the price will go up. Okay, the price will go up. This depends on the stock volume. Okay, because understand that some stocks, especially penny stocks, with little volume, you can see the price change too much. But you see bigger stocks, it has millions, and then you see it's only cents. So it depends. So when I say this, it depends on the stock, and it depends on the stock. It depends on the if the stock is big or small, and it depends on the activity each hour or each day or each week. So each day is different. Now, one of these days that are different is the day that you should see the earning news. Understand, when we are always speaking about earning news, understand that it's not all the stocks that respond to the news. I will give you an example. Go take 10 or 20 or 30 stocks, just at random, and check the last earning news. Okay, it means when the company announced the quarter results, which is 3 months, and after that the company will say if they make money better than last year, or if they lost money, what are the problems, what they should do. This is what the company should be doing. Now, so what you should do, you can take, for example, 10 stocks that are not known, not like Facebook or Twitter or Amazon. These are stocks are very, very known and the media speak too much about them. But go just to some stocks that no one speaks about them, penny stocks, or some stocks that are, let's say, $2, $5, $2, $7, and they are not known. When you see the company, you don't know it. So if you do that and you go to the earning news, what will you notice? You will notice that these stocks, when they announce, the company announces the information, good or bad, the stock doesn't move. So why is that? So this is just to get an idea why these stocks don't have a gap up or gap down. And why, for example, Apple, Facebook, Twitter, Amazon, Tesla, Netflix, all these bigger stocks that all the people know, they have a gap up or gap down. Okay, it means the price changed very, very much. This is in general because the people, the traders, they don't know these stocks and they are not interested. They don't know them. So the traders always go to stocks that are very known, that they see something. They see something which is volatile. That's why, as always, day traders always are looking for things that are volatile. Hello, Basan, how are you? Gig you, Bas. Today you come on time. Hope you stop shopping. Yes, I know you are Basan. I know. I can remember your ID very easily. And in YouTube, you are all the ways or always. I know. And your email is another thing. Thank you very much for coming. So, as I told you, I developed this subject about volume and how these stocks, in general, they don't show any response. Okay, so let's I just as I explained this, I will right now we'll go and just give you an idea about what I am saying here, just to get clear idea about what I am saying, and just to get the best of the information I give right now. So just bear with me. I'm going to show you. I'm going to just to explain. Okay, I'm going to explain. So let's go for the explanation. Okay, so let's go to the explanation. As you can see here, I will be doing some explanation. Now, we can do in the earnings. I just give you an example. Okay, here. Let's say we have known companies, okay, and unknown companies. This is just to show you something very, very important about the volume and about the earnings response for the gap up and the gap down. Okay, now let's say known companies, Apple. Apple today, I will show it later. Okay, today it has a gap up. Okay, it should be good news. So congratulations all the guys who have bought Apple. Okay, now we can see Facebook. These are just some known companies that they spend. We have Twitter. It doesn't mean that these companies are big or not, but it means they are very known. Let's say you can take Tesla. So Apple, Facebook, Twitter, Tesla. You can say Amazon. Okay. You can say Google. These are companies that everybody knows. When I say, for example, Apple, you know, everybody has a smartphone in general, so they know Apple. Facebook, everybody is in Facebook. Twitter, some companies are there. Tesla, all the people are interested in this electric cars. Amazon, everything you want to buy, you go to Amazon. Google is everything. Whenever you want to search, you know Google. Okay, so these are known companies. Now, what is the thing about known companies? Is that you have it's first we can speak about the volume. They have a high volume here, high volume. And high volume, what does it mean? It means we have a lot of traders watching always these stocks. Traders, a lot of traders. Now the result of this, when for example the news comes here, the news comes to these stocks, everybody are watching. That's why for me, when I do some videos, I try to speak about Apple, Facebook, Twitter. Okay, I don't go to the biggest stocks because most of the people, they don't have money to go buy $300, $1,000, $2,000, I don't know. So I'm not going to show them. But it's the same thing, okay? It's the same thing. Now, since they are known people, the brokers and big companies, they make what we call analysts. Analysts are those people who are assigned to Apple, for example. You find a lot of people are always in TV. You find them in websites, CNN, CNBC, Bloomberg, other websites are speaking about these companies constantly. It means each day you will find Apple has done this, Facebook has done this, Twitter has done this. It means they speak too much. Why? Because we have analysts, they analyze these known companies. They just speak about them, giving information, and if there is something new, they will tell you about this thing, okay? Always. So that's why when there is, for example, most of the time, good news like today for Apple, we have good news. That's why we have a gap up. So this generally are good news. And this is what the people are looking for, example, good news, and they buy. And I will explain later how these things work, and if you want to do it, how to do it. I will explain later about this. So now I am in general, I'm just giving you a general ideas how this gap up or gap down form to some stocks. Now, on the other side, okay, on the other side, you find unknown companies, okay. So unknown companies, sorry for that. Unknown companies. What is the thing that you can see about this? Is that most of the time we have no analyst covering these companies. It means It means no one is talking about these companies. Okay, so no analysts, or you find only one analyst who is interested. So the people, they are not interested in those because there is no big coverage. CNN, for example, doesn't speak about thousands and thousands of stocks of companies that are unknown. Okay, they have little earnings, and they don't do that much. Okay, so no one is interested in them. So there is no interest in these stocks. No interest. Now, no interest from whom? From the traders. Since there is no interest of the traders, so they have low volume. That's why most, for example, of these stocks are penny stocks. Penny stocks are small companies that most of the time they have a low volume. No one is interested in them in terms of TV and big websites, and they don't speak about these small companies. Always they speak about Apple, Facebook, Twitter, these big things that attracts a lot of traders. So that's why penny stocks, when you go to them, okay, most of the time, and other kind of stocks, they have no gap up or no gap down. Okay, now why is that? It's just because there are no traders that come to buy because of the good news or bad news. No one comes. And as you can see, a lot of times when you see the earning news, the stock doesn't move up or down because there is no traders coming to these companies. It could have some people coming, maybe they have an idea, but when they buy, things will not change that much. Okay, and the more the people are excited because of the news, the more the stock can go gap up. Before, so this is just a general idea about known companies and unknown companies. Okay, now no one knows. When we have a company, no one knows if there will be a gap up or gap down. And this thing makes what we call the suspense. Because people, if they know or they have a means to know, they could make millions of dollars in 1 month. Okay, because they know everything and they predict. But understand that this thing you should never predict. The only thing you can do is look at and listen to the news when it comes and see the price. Okay, so that's it for just to know this thing. Okay, it is just a general idea about why you see yourself. You say, why this company always it has gap up and gap down? Why? And other companies that you go and you want to check, you don't find anything. It means you find the stock is going up or down, but there is no gap up or gap down. And you ask yourself, why is that? It is just because this thing has a relation with analysts and traders and the common interest in the nation. For example, here in America, we always speak about big companies in the Dow, for example. Okay, Dow Jones companies, S&P 500 companies. It means bigger companies that make a big change. They say they will show you, for example, a big company buys other small companies that are also known, but they are not too much known and they don't make that much money. For example, we can say Google bought YouTube. Now, why do you think Google, why does he need YouTube? Yes, because YouTube has customers, has people they come to watch, and they can put ads and they can make money. So Google, when it buys or bought YouTube, this is a very good thing for their business, for Google business. Okay? If another company, Microsoft for example, or any other company, or Yahoo bought YouTube, it will make more money than now. Okay? So Bassan said, hi. Now I have to find another nickname to hide myself. Yes, you should hide yourself, but understand that when you say I am Bassan, it's over. I memorize and try not to forget your email, Bilbil. Okay, I know your email also. You will go nowhere, man. So now I will show you right now, just to continue my explanation. I will show you how this thing about volume changes. Okay, so let's go again to the explanation. Okay, let's go to the explanation again, and I will show you something. I will show you something about how these things work. So always try to see that there is a little delay when I am working on the thing. Okay, now let's take an example of Apple today. I will show you the chart. I will show you the chart later. So Apple, for example. Now, so Apple, this is, for example, 4 p.m. Okay, 4 p.m. This is the close. It means Apple closed at 4 p.m. Here is the line. This is the line of time. We can say the timeline or something like that. The time. Now let's say this here is the morning and the afternoon until 4. Now this is where here 9:30. This is what we call AM. This is what we call the trading day or trading hours. Hours where the volume is so high. The volume is so high because a lot of traders do, and this is the activity for the market. The market when it is open, this is what we call the trading hours. Now, after 4 p.m., volume drops. Now, why the volume drops after 4 o'clock? Just after 4 o'clock. Because all these traders that they trade in the morning and the afternoon, they stop trading because they sell and that's it, because they are day traders. They stop trading because the bid and the ask was so good. Okay, let's say it is 1 cent. I always like 1 cent between the bid and the ask. Okay. And people, they buy, they sell, a lot of activity, a lot of selling, a lot of buying, a lot of stuff. So the stock could be going up or going down. It's not important. Now, understand that after 4 p.m. here, we will see the news. If they give the company, if they give a special time, for example, they say 4:15. We will have the announcement. The company said this. But most of the time, sometimes it says, sometimes it doesn't say. So you should go ask your broker or find information or go to the company itself, like Apple, and see when the news will be. It means when the company, they announce the third quarter. Okay, so this is what we call the announcement of the third quarter. It means the quarter ending in I think 31st December. It means, what do you mean by that? It means we are speaking about December, November and October, 3 months earnings, and we try to compare them between for the last quarter of last year. Okay, and we try to see if Apple is making more money or is making less money, or what is the problem. Now, this is the scenario that comes if the news is after the market close. We will see this. Sometimes we have the time, exact time. Now you should either find a service, or you should watch, for example, TV. Here, when you watch TV, this is not for entertainment. When you watch, it is only if there is the guy from the company, a CEO or executive, he is announcing the news. So if there is this, put the screen of your TV and watch. And what is the most important thing you should see is the price and bid and ask. Okay, this is what you should look for. Now let's take all this, and I will explain right now what will happen. So let's see here. Let's see the price of Apple. 154.68. $154.68 is the close. This is the close of Tuesday, of today. It means the close. Now let's say the bid is 154.68 and the ask is 154.69. This is 1 cent. Here when I always speak about 1 cent spread. Okay, 1 cent spread, it means between the bid and between the ask one. But after the close, okay, you will see that, for example, these changes. Let's say it is 154, it becomes lower, let's say 25, just an example, or 26, and the ask is 154, let's say 85. So you should see that the bid and the ask, we have a higher spread than 1 cent. Okay, so it's 58 cents. Now why you see that? Why there is a change? Because there is a drop. There is a drop in volume. It means people are not trading anymore. Few people are trading after 4. So the market makers who makes the bid and the ask, so this is the bid and this is the ask. The market maker, if you know a market maker, what they do, it is they facilitate the market makers. They protect themselves by spreading the bid and the ask, because they want to make money for sure. Because understand that market makers are doing a job where they facilitate the market when they buy from someone and they sell to someone. For example, after because for example, before the market close, okay, you want we have two guys, okay, you and your friend. You, for example, you are scared to stay for the news. You say, okay, I have been with Apple 1 week or 2 weeks or 3 weeks. I have made money. So today is the news. I don't know. Maybe we have a gap down. So I will lose all my money that I accumulate in these 2 weeks or 3 weeks. So you say to yourself, no, I will be selling my shares and wait for the next day and see. So when you sell before the market close at 154.69, so what does the market makers do? He will sell you from 154.69 Apple. He will sell it to you, but he has already bought from someone else at 154.68. So you say to yourself, how much he make? He make $1 for 100 shares. Now you ask yourself, oh, these market makers are not making any money. No, they make, because because each day they can make hundreds of thousands or millions of shares traded a day. Whenever you buy, whenever he sell, he makes money. So if he makes $1 from you, but there are hundreds of thousands of people they buy and sell, he will make hundreds of thousands, or he can make millions of dollars. But after the market close, the volume drops, and you see that he is making a lot of money. Now he is making 58 cents. Now when you want to buy, for example, you didn't buy before, you have forgotten, or someone tells you, oh, today is Apple news. Maybe if you buy now, maybe if it's gap up, you make money. So you come very directly and you buy at 154.85. Okay? But before it was only 154.69, so you lost money. But it's okay. You want just to enter and maybe you have a gap up. So the market maker is making 58 cents for each 100 for one share. This is one share. Okay? So $100, he is making $5.80 for 100 shares. So now he is making more money in each 100 shares. So because he will just sell and buy not too much. That's why he is making more on the one share, but he is not making more in terms of money, because after the market close, a lot of people, they disappear. All these traders disappear because it's the end of the day. But since today it is the news, some people stay buying and selling. Okay? Now, in order that you want to trade Apple with the news, what is the thing that you should do in general? Okay? So this is a very dangerous trade. If you want to do it and you are new, you should not buy a lot of shares. For example, you buy 10 shares, 15 shares, 5 shares, just to try to do this trade. Because this here we are doing trading. It means you buy and you sell in the same day. This is not swing trading, okay? You can do a swing trading also, but this here I'm speaking about day trading, not swing trading. Okay? So, in general, what is the thing that you will be doing now is you should have a source of information. It means you should find where to find the news when it comes. Because the news, when it comes, you should either read or hear. But most of the time they announce it. Announcing, it means they speak and you should listen. So people, they prepare everything. Okay? I'm telling you right now, it's a very, very difficult trade. It's not as easy as you might think. There is one which is difficult and one is easy. I will show you the difficult one and then I will show you the easiest one. Okay? Just to make sure you understand, because according at it how it happened. Now, so let's go to the explanation again. Okay, so we will try to explain this. So we said that the price here is, for example, let's say here, we make this as, this is the person. Okay. Okay. So this is the person, and he is, let's say he is speaking about the company. This is Twitter, for example, or Apple. So this is the TV, and the guy will begin to announce the information. We say 154.68 is the information, and then you should look at the bid and ask. Now, so all this here, let's say this is how you make your plan. This is Apple price in your broker, and this is the bid and the ask, and you are looking at the chart. Okay, the chart, for example, showing you where is the price now. Now, when the people, they say the news, it will be so fast in the change here. It's not that it goes slowly from 154, it goes to 154 70 cents, and then 75 cents, like you see it in the day. No, because the people, because there are, let's say we have 50,000 trader waiting for, just an example, okay? 50,000 traders are waiting like you wait. They just listen to the news. Whenever he said good news, now how do you know it is good news or bad news? Okay? Now, 417, this is what the analysts say, that per share, the EPS, we have spoken about this. We have spoken about this yesterday. It means the analysts, they say that the company will make $4.17 in the earning per share. It means how this earning per share is calculated. I will just try just to explain for those who have not been here yesterday, and then we can continue, because a lot of things you should know, because this is what we call the plan. You should plan and wait and be ready to do an action. Now, the EPS, it is the earning per share. Okay? How do you get that? You, for example, you have the earnings, whatever is the earnings in millions of dollars or billions, and you divide by the number of shares, common shares that Apple has, common shares, okay? And then you will have this number, which is $4.17 per share. It means if you own 100 shares, normally you will have $417 as earnings. But understand that this is it's not for you. This has nothing to do with the stock market. This has to do with the company earnings. And I have explained a lot this idea of the earnings of the company and the dividend that we speak in stock market. They are different. Okay. Now, so who will give this EPS? It is as I told you before, it is the analyst. Analysts, they calculate by numbers, okay? I don't know how did they get this information, but they dig and they search for information for the company, okay? And they give an estimate. This because analysts, when they say 4.17 per share, it is just an estimate. It's not a true information. Now, who will give a true information? Who? It is Apple company. When they announce, let's say today, I didn't check how much it is, but we have a gap up. It means it should be more than 4.17. We will check it later and we will see. Okay, no problem. So when the company said that the earnings, an example, okay, are let's say 57, it means that the company EPS is better than the analyst EPS. Now this creating a good news to buy. Okay? So whenever they announce 4.57, just they announce it. There are 50,000, for example, traders. I don't know how many, but I just put a number because it's very hard to get this information. Understand that Apple, there are millions of traders all over the world. They are trading here in USA, and they can reach our market and they can buy and sell like us who are in the USA. So it's the same. So it doesn't mean that he is in Japan or China. He can't buy and sell shares. He can. When he make an account, he can do whatever you do. Okay? Now, as soon as this information is told, people react. They have their plan. Okay, we take this. Now, let's say, but the problem is that, I will tell you right now, a problem. This is good news. How many seconds do you think this price will change in a gap up? How do you think? Do you think it will take half an hour, 1 hour, 2 hours? So what's your opinion? It will take less than 1 second. This, for example, 154.68, it can go to, for me, I say $10 in my video, but I don't know if it is true or not. Let's say it goes to $164 in 1 second or two. So if you are so powerful to execute, you should have a very big broker with high execution. If you did this, you can get this gap up very quick. But the problem is that hundreds of people have already bought before you, less than 1 second, because they have a more sophisticated account and they can get more direct access to the market than you, so they can get better price. And this is called the first step that most of the people, they don't know, but I will show you. This is what we call phase 1, which is called the gap up. But, and this is quick. I say just, for example, 1 cent. 1 second. 1 second. Okay? 1 second in time. Now you tell me, Karim, you tell me, for example, you tell me, how do you know that? Okay? You tell me, how do you know that there is this phase and there is another phase? There is a phase that it is so quick and there is a phase that it is not quick. Now, I will be sure that I will show you by the chart. I will show you this stage, how it will happen. And then I will show you the other stage that it is, you can buy if the stock continues to go up. I will show you this phase, and don't be, you should be just patient, and I will show you that. So let's go back. Okay. Now, so the gap up, the quick, I will show it. It will be like this. For example, it was, the price is going down like this. These are candlesticks, for example, and then the candlestick that it is going up, it should be only 1 in 1 second or 2, and it should be so big. And the price, for example, goes from 154 to 164. Just an example, okay? Here I'm just giving you an example of a candlestick that it is only 1 second. Understand that from 4 p.m. we are going in time into 8 p.m. Okay, so we have 4 hours. Let's say the stock after 4 p.m. goes a little bit in. These are small, for example, one minute, and this, you will never know how quick it goes. Why? Because this is big. This candlestick is big because it has large volume, thousands and thousands and millions of shares traded in seconds. Now, who buys? It is the traders. Some of the guys, let's say traders, 20,000 traders who are excellent in trading, they just hear 457 and they buy, because they are just waiting to click on buy. Okay, that's why you see this large goes very, very high in less time. This is called phase 1. The stock shows you a gap or a very long candlestick, and this most of the time most of the people, they can't get it, except if you buy before the news. Let's say you buy at 154.68 at the close, you buy, and you think that you do a trade thinking that the stock will be a gap up. So here you don't need to be as quick as them. For you can just buy and wait for the guy to speak about the earnings, and then you have heard that it is 457. After a few minutes, 1, 2, or 3, you begin to search, and then you see that the price has been changing from 154 to 164. This is the first phase. It's okay, you have made your money. Now, at this time, if you see that it is a lot of money, you can sell. This is the good thing about the earnings, because we have a high volume. So this, after hours, from 4 p.m. to 8 p.m. becomes high volume, the same as trading hours. It's just because the traders, they come. Now, why do they come? Because they know earning news of Apple is today, and it is after the market close. It is like when there is a party. You know that the party is after 4 p.m. and you go to the house and you wait until your friends come to have the party. Okay, 4 p.m. not before. You come at 4 p.m. and you stay at 8 p.m. This is the party, how it works, in order to have fun. Okay? Now, what is the second phase? Okay, so let's go and I explain to you now the second phase. Excuse me. Okay, so phase 2. Now, we say 4 p.m. Now, we say that the stock has been going down a little bit after 4 like this. And then this is where the news comes. We have a very, very, very long candlestick like this. And here, let's say the stock is 164. And here it is 154. Listen, this is just an example, okay? I will go to we will go to the chart on Google and I will show you this. But these numbers are just fictitious, okay? Because I want just to explain, and then we can go and see directly what did happen. Now this, for example, is 1 minute candlestick. It's 1 minute candlestick. Those who are using, most of the people are using one candlestick. Okay, what will happen from 4 p.m. let's say to 8 p.m. the stock continues, listen here, continues like this. These are minutes, let's say like this, until it goes to, let's say, 164. Let's say you say 168. Just an example, okay? So from this to this, we have $4. This is the easy trade if you want to do. If you want to do the trade, you should find the second phase, because the people, they come, those 20,000 they have done here. 20,000 people or traders have bought at the beginning here, so they get too much money. Now the 30,000, for example, who are traders but they are not as good as the others, because only 1 second it's gone, they begin to buy here, and they can make $1, $2, $3, $4. And understand that when you see the orders, you get astonished that some people are buying with 1 share. You can see it in Nasdaq: 1 share, 2 shares, 5 shares, 10 shares. Some people are just they are new, they don't have money, and they try to be like professional, but they don't have money. Okay, so in this second phase, the stock will be going 1 minute by 1 minute, going down, but it doesn't go so fast. It can go 5 cents in one minute, or 10 cents, or 2 cents. Okay, but not like this one, which goes $10 in one minute. This is $10 in 1 minute, for example, or $6 or $7. This is very, very quick. And this is for those who are what we call sophisticated. Sophisticated traders are people who have too much money. Okay? Either they are hedge funds, or they are traders with large money. Okay? So they are not someone who buys 100 shares or 500 shares. No. They are sophisticated. They have money. They can buy. They can buy here. They can continue to buy here. It means they have the money to buy and sell. Okay? Now, later, some people, we have red candlestick, begin to sell until 8. Now, those people who begin to sell, most of the people are sophisticated. Sophisticated people, they do a day trade. What does it mean? It means as they bought to make a trade, they sell to finish the trade before 8 p.m. Because let's say you don't exit the trade. Okay? So what will happen? It means you are going not to do a day trade, you are going to do a swing trade. It means you stay until Wednesday, which is tomorrow. But understand, tomorrow you will never know what will happen. Maybe this here 168, it goes down to 156 in the morning. You will never know. So when you hold, it means you have a big risk to lose your profits. That's why day traders, they don't do swing trading. But beginners, because they don't know the difference, they buy here, they make some money, and maybe tomorrow they lose this money because they don't know that a day trade is not a swing trade. And this, what I am saying here, is I always try to make people understand that day trading should be a day trader. Now, if you want to do a swing trade, you should plan. You should plan this before. You should plan it. You say, for example, okay, I will buy as a day trade. I will buy. But if I lose, I will sell. But if I don't lose, I make money, I will stay, I will hold for the... It means you should plan this. But understand, in general, that sophisticated people, if they are day traders, they will never hold for tomorrow. Never. I will tell you why. Let's say you bought and you make, let's say you have money and you make $10,000. You made 10K or 20K or 30K or 100K, depending on how much money you have, and you hold for the next day. What if a mutual fund, for example, he wants to get rid of millions of his shares because the stock has been going so good and he wants to sell Apple in order to buy another stock. In the morning, he will sell millions, and this $10,000 that it is a profits will disappear in the morning because the price will be going down next day, and you want to see your money, your profits. You don't find your profits because someone else had been selling off, like a mutual fund. Because understand that mutual funds, when they move, they crush anyone, because they if they own millions of shares and sell them at in the morning, the price will drop heavily, and they just exit the trade. Okay. So guys, we have right now 1 hour. I have tried to explain how this first phase, second phase, how does it work, and how you can enter, and what is the difficulties if you are a day trader. Because understand, if you are a day trader, you need more from your broker than when you are doing swing trading. Swing trading, is the easiest. At the end of the day, whatever price you have, you buy, and that's it. You are not worried about 1 cent or 5 cents or 10 cents. You are not worried that much. But in day trade, you are having just little time to do your trade in the day. If the stock moves so good, so you should take advantage of this, and you should make some money in this few hours. But if you are, let's say you are a swing trader and your stock is doing good, you can stay a few weeks, 1 month, 2 months, 5 months. I have done a trade 5 months and 2 weeks, and I put it into training level 20. My live trades. Each week, I bought the stock, and each week or 2 weeks or 3 weeks, I will make a video if something changed, and I show how I follow this for 5 months and 2 weeks. You can stay 6 months, 7 months, 8 months, depending on the stock trend. But in day trading, you don't have that much time. You should make time. You should make profit. You do the trade, and then you exit. This is what you should do. You shouldn't stay the next day and then you risk. Because ask yourself, why day traders, they don't hold for the night? Why? It's just because there is a risk holding the stock. Maybe there is a news in the morning and your stock go down. Instead of taking your profit, you will find yourself losing all that profit that you made yesterday. And this is a mistake that most of the people who does this mistake, they are beginners, because they don't understand that styles of trading. Day trading is one style. Scalping, like in day trading, is another style. Okay? And swing trading is another style. Position trading is another style. And then we have the long investing that most of the people know. It is to invest for the long run for companies that you know the thing. Okay? So, right now, since I have told you, we should see Apple, and where is phase 1 and where is phase 2 about the day trade that you can do. Now, it doesn't mean that all the stocks will have the same thing. Understand that the chart is made by the activity of the traders. Okay? So, now let's go to Apple. Okay? And let's go to to see Apple and what did happen. Okay. Now, as you can see, guys, you can see Apple, and I will show you how this happened. Now, as you can see here, 4:30, the stock from, you know, here it was 154, 68 was at 4 o'clock when we have the close. The stock has been going up a little bit, and then it go down to 153.05, and then see here in 4:30, in 5 minutes it goes to 159.31. Okay, and it continues 4:55 here, then it go down 160, and then it goes till 164. So here from 4:30 to 4:35, this is the phase number 1. Then we have another phase from 4:35 to 5:25. This is phase 2, where you can trade easily. And then later the stock doesn't do nothing, because some people, they sell here, you see, 550, 40, some people begin to sell here, some buy, some sell, some they do some trades. Now, at 8 o'clock, the stock is 163.50. It goes $8.82. Now this, understand that this will change tomorrow, because tomorrow we will never know. Okay, it will change. So understand that this is what happened. Phase 1 is only 5 minutes, 1 minute, 2 minutes, 5 minutes, from 4:30 to 4:35, from 4:35 to 5:25. This is the second, and then the stock doesn't do that much, because people, they begin to sell. There is no much more to do, because this is where the people have bought. They have bought from 153 to 164.24, and then it goes down to 163.50. Okay, so you understand, this is the second step. So if you want to trade, you should trade the second. Now, how do I know it is the first phase? It is only one line. One line, it means you can go to your broker, and you can see after hours, and you see this, that it is so quick, and this is what we call phase 1 and phase 2. Okay, the easiest you can do is phase 2, because it takes time. Okay, it takes time, 4:35 to 5:30. It's nearly 15 minutes. So here you are doing trade very you have time, but here you don't have time. Here is just 5 minutes, and the stock was going down. Now you know that there are some people, maybe they think that there is a gap down, so they do what? They sell short. Maybe some people are selling short, thinking that Apple will go down. So it depends on the idea of the people. Okay. So this is just in general, and as you can see, this. What happened in the day today? It doesn't matter. The stock has going down $1.62. It can go up, it can go down. So this has nothing to do with the news. So understand that. It doesn't mean that when the stock goes down that we don't have a gap up. So because the gap up is because of the news, not because of the trading of the day. Okay? Now, so it is 163.50, $8.82, and congratulations for all the guys who have bought Apple. And what does Basan said? When a trader begins to trade bigger positions as buying, for example, 20K, 30K, 50K, each stock in his portfolio. Yes, you can buy, understand, Basan. You can buy whatever you want. You can divide your account and buy whatever. Now, when you say 20K, 30K, 50K, it's not big because Apple is a big stock, 154. Okay, so you are buying hundreds of for example 50K, you are buying 120 shares. So what's this 20K that you are talking about? Or we say 30K, 50K, each stock in a position. Now, if you want to buy, I don't understand what you are asking. Are you going to buy? It means the whole account. Let's say you have $100,000 in your account. You want to buy all your money? Yes, you can do that, but the risk is too much. Let's say you mistake. Instead of going up, you see the stock like I showed you right now. The stock was going down from 154, it goes to 153. So it was going down. You think, for example, it is bad news because you didn't see the news. You are not sure. And then you sell short. And then after 1 minute or two, you will be losing $8 or $7 a share because of this. So if you buy with the whole account, you are putting all your account into a bigger risk, and this is what we call risk management. And then you say, sorry, I don't want you to get out of the subject. You want to talk about it. Which subject I am going? You are a mess. Basan, you are a mess. What is the subject I'm talking about out of the subject? I'm still speaking about the earnings, about day trading, how do you day trade, and how the people are misled between swing trading and day trading. This is in this subject. I'm not speaking about another subject. So I don't understand what you say. It means I don't get your idea. And which subject I talk about, which is out of the subject. So you should write again, what do you mean by that? Because I don't understand you. I'm not speaking about options right now, or about futures, or about other things. I'm speaking about earnings. And right now, no, listen. Basan, you have written one sentence and you say, when a trader begins to trade bigger positions as buying, for example, 20, 30, 50, each stock in his portfolio. Where is the question? Where is your question? You put question mark, but it is not a question. Okay? And then you say, sorry, I don't want you to get out of the subject you want to talk about. No, ask your questions. I will answer you, Basan, and you are not stopping me from continuing the thing. No, just ask, and I will answer you because I'm trying to develop this subject and to give more details, and these details I have never given. These details of today I have never given before. So if you go to my YouTube channel, you will never find this kind of information. It's just because I want to add more information for this. So you are not interrupting. You can ask your questions, guys, because this is your opportunity. Because you are watching and you are following me, this is your opportunity to learn more if you have specific question. Because for me, when I give you these details, you should ask questions if you have questions, okay? Or if you have traded before, you have traded and you have another opinion, you can tell me and we can develop that. Because I can't just talk for 2 hours without interaction with you guys. So you should ask questions and ask questions in order that I will answer you. That's why you are here. That's why we have the chat. If it is one way, I should just make a video on whatever subject, and I speak, and then you can't speak and you can't change and interact with me. That's why, Basan, if you have some question, please ask the question. Now, your question in general, you can make your positions bigger and bigger and bigger, but you should understand one thing. Yes. You say, I understand the risk buying 100 from each stock and buy 5 stocks for 100k each. But the risk is the same with 5k each. No. Listen. The thing you are not. I'm not saying you buy 5 stocks for 100k each. No, this depends on your account. I don't care about how much money you have. I will give you an example right now in order to understand what I'm saying. The risk is based on how much money you have. It's not on the money itself. I will give you an example. So please, I will explain this example. And then if you have a question, you can ask me and then we can deal with that. Okay? So let's go to the explanation again. And please, when I give you the example, and then you can tell me if this is what you are meaning or you mean something else. Okay? Now, I will give you, for example, you have a $1 million account. Just an example, okay? You have 10 positions. It means you are buying 1 stock. Now, it means you are buying 10 stocks in 1 million. So 100,000 for each stock. Okay? Now, another guy has 25k and he has, let's say, 5 positions. Okay, 5 positions, stocks, and each stock is 5k. Now the risk depends on how much percentage and amount of money you want to risk. For example, when here, let's say here 100,000 a stock, you want to risk 5%. So what does it mean? 5% for you. It means you are risking 5K. This is your risk in each trade. It couldn't be the same because understand that stocks are not the same. Now, here you have 5%. So how much you do? I think it's $250. 5%. If you have 5,000. So this is normal. If you have 1 million, $5,000 for this trade risk is the same as when you have 5% for this stock, which is $5,000 for this stock. This is your risk. Okay? So just to make sure you understand what I'm saying, 5% is $250. But if you want to put 100,000 and you want to have $250 as a risk, this will never work because the percentage will be 0.05, I guess, percent. This no one will do that. You can't do that because the risk is very, very, very low. You can exit at any time. So understand that the risk is by percentage, and when it is by percentage, you see how much you put in a stock, and then you can see the money. But don't compare 1 million to 25,000. So, for example, you have 1 million, okay, and your friend John, he has 25. So he when he do 5% in this stock, 5K, he can only do 250. When it is 250, he exits the trade because he can't stay. This is his risk. But you risk $5,000. It is just because you have $100,000 in this stock. So understand that this has a relation with management, money management. Okay, so hope that this example. Please, Basan, if you have a question right now, try to ask me a question about these two examples I gave, and tell me if this is what you are looking for. If you are looking for another thing, you should tell me right now what is this thing that you are looking for. At least I will understand what you mean. Okay. So this is my explanation, and let's see what Basan said right now. Okay, so let's go to what Basan said. At least I will understand. So you said, I understand the risk buying 100,000 from each stock and buy 5 stocks, but the risk is the same with 5K. So could you tell me, Basan, right now, I have showed you 2 examples, and I show you an example of risk. Can you tell me now, is it this what you are looking for, or you are asking something else? Because you have given me the you try to understand this. Okay, so please just write your question about these 2 examples, and then we can continue. We are 11:25 minutes. You said, I got it. I am sure. Tell your students not to buy too much because they can't hurt themselves bad. Yes, yes. Listen, anyone who took my training either one by one, like direct training, or by my training by levels, they understood this thing. Yes, yes, it is a security measure, yes. Trading is to know your risk. I will tell you why most of the people, they don't succeed. Just because they are looking to make money, but they don't look at their risk. Okay? So it is as if someone tells you right now there is a war, to be a soldier, and they give you $1 million in your account right now. If you go now for 1 month, you do the war and you come back. Understand that $1 million is good, but the risk is your life. So you are just like selling your life for $1 million, but you can come back. It's very good, but sometimes you don't come back. So this $1 million is not, you don't have to do anything with this. Okay, so let's security measure. What you say as a security measure, this I teach in training level 8, how to minimize risk and how to maximize profits. I will explain this, just the idea, because I don't want to go into details about the training, but I will just give you an idea about the trade. Okay, so I will just explain. And those two guys that you are watching, we are 3 guys watching right now. Please, if you have any question that you want to ask, please ask. Don't be what we call don't be hesitating to write something, because when you ask more questions, I will give you more information about the thing. Okay, and tomorrow this video will be also available available. You can watch again if you missed some information. Okay, so let's give you something that most of the beginners they don't think about, although it is the heart of trading, is managing risk. I will tell you why is this so important. Okay, so let's go to the information, and I will just try to give you some information about the trade. Okay, and please, while I am explaining, guys, if you have questions, just ask. Okay, just ask. Now, let's say for me in the chart, I always use colorful lines. Now in the chart, and my chart that I use, as you might know, all the people know, it has lines. You can put colors, and I use a lot of color lines. The most important thing when you buy, let's say you buy, just an example, okay? Let's say you buy Apple, okay, today, before the market close. Now when you buy, you try to put a green line like this, and when you click on the line, and you will put how many, it means how much you bought the stock. In the future, when you want to see your trade after 1 week or 2 weeks or 3 weeks, you will find all the information by lines. Okay, this is a horizontal line, this is the buy. Let's say you buy the stock at 154.68. It means at the close you buy the stock. Let's say you put here a red line. This is the stop loss. Stop loss. Okay? Now, let's say the stop loss is 152.68. Let's say you want to risk $268 in this trade, and you bought 100 shares. Now, here is the thing. Okay? Here is the thing. Most of the people, when they buy a stock, they don't plan. They do no plan what to do next. What if the stock goes down? If you don't put, for example, stop loss. Stop loss is just a means of risk management. Risk management, what does it mean? It means you say to yourself, if I can't bear the price, okay? If I can't bear the price, I should sell. So stop loss, it means you sell at this price, which is 152.68. Now, all this is what we call to plan for the trade. So you make a plan before even you do the trade. You make the plan, and this is how you become a trader. Okay? It's not just you buy and you wait and you see what's going on. Now, for the profits, no one knows how much profits you will get, because this is the future. So you should never what we call price target is done in day trading, but most of the time it's not good to stop your profits, because as we have seen in the example, from 153 it goes down to 153. It goes to 153 as we have seen, and then the stock goes to I think let's see the stock where it goes. 159. Yes, 159. Okay, it's 159. Just to make sure you understand this. Now, 159. Now, let's say you said to yourself, because you don't know where it goes, the stock, you say, okay, if there is a gap up, I bought at 154.68. If it goes to $4, I will make $400 as a profit. I exit here. And you put a stop loss. You can't put stop loss at when you are after hours. You put a sell limit. It means if it goes that price, you will sell. Now the problem here is that when you stop yourself at $4, okay, the stock continue to 159 and then it goes up to 164. So all this money, $500, that the stock has gone, $500 that you can make with 100 shares you bought, you lost this profit because you stop the profits from getting there. That's why you are doing a mistake by stopping your profits. So most of the people are thinking to make money, but they don't do the risk management. And this is one of the biggest problems of traders. Day traders, the swing traders, is always they have this idea of hope. It means when they buy a stock, they hope it will go up. They will never hope that the stock will go down. But understand that you are carrying a business. You buy a stock, it can go up, it can go down. You should take your responsibility about that. You don't play the fool in the market. Playing the fool, you will pay, because the market will punish you because you are not careful. So if you are careless, the market will punish you. And a lot of traders, they do a lot of mistakes. One of these mistakes is they don't do risk management, they don't plan, they exit early. All these are problems in day trading. Okay? And understand that all these, we have a lot of techniques to make sure you are complying with the basics of trading, risk management, to plan for the trade, and so on. So it's not always that easy. Okay, so you should need to work and to practice a lot in order to reach where you master the trade. And one of the things that you should master is you should plan for your trade, and you should take care of the risk. Don't play the fool and buy and thinking that the stock will never go down. This is a problem. Okay? So let's go. So I see that no one has written any other question. So we have about 22 minutes. So I will continue with the earnings. And in general, buying through the earnings is a very risky job. If you are an investor, don't worry a lot. If you have a good company, sometimes you have a gap up, sometimes you have a gap down. So you know the company, and you know that this is not so serious. Okay? Because you are looking for many years. Warren Buffett said, for example, because he is one of the best investors in the world, he said that when you think about a company, think about 20 years. This is how to become an investor. Okay? Not to buy today. You are an investor, you buy today. Tomorrow there is bad news, you sell and you say, oh, I lost money on this investment. This is not investment. You have made a trade. And you should make sure that a trade is not an investment per se. Because an investor is someone who is investing, is not trading. Warren Buffett, he doesn't buy Coca-Cola in the 50s or 60s or 70s. He bought it and then the next day he sold it. No, he held for the company because it grows each 1 year, 2 years, 3 years, 5. It grows. It becomes bigger and bigger and bigger. And he's taking more money from it. Okay? That is the thing that I am always speaking about, that you should not confuse yourself with investing, trading, and so on. So if you are going to target some stocks for trading, like to trade the news, so what you should do, you should make a portfolio and you search for the what we call the earning date. I think before let's say I will see the calendar. I see before Yahoo has a good calendar, but I will try to check. Okay. Yes, I think Yahoo has the best, I guess. Okay. So now let's here I just give you some how to do it. If you want to trade earning news, how to find these stocks is very easy. Okay, so I will show you I will show you Yahoo calendar. You can write earning calendar. Okay, and let's see here. Okay, so I think now you see the calendar, and it gives you day by day. Okay, it gives you day by day. So today is 29. So 29 is today. Okay, so you will see all the companies. Apple is here. You see Apple after the market close, the earning call time, and it is 417 EPS estimate. Now here reported EPS, it means what is the EPS that the company report, but there is no information. Okay, you should go to news in order or the company to say. Okay, so you can check all these companies, and it says here before market open. So for example, if you go to MMM, they say EPS is $2.28. Okay, so let's see MMM stock and see if there is a gap up or gap down. Okay, so it's $3.97 because it is before the market open. Let's say is it the market open? Yes, before the market open. Now let's see after the market close is better. Okay, EGHT. EGHT. Okay, so look here. Now the close was $19.31. Now after the market hours, you see 1750. You see it was so the stock lost 9.37%. It means if you put, let's say you put $10,000, you lost $937. It means nearly 1,000. It's nearly 10%. So you see that? Okay? But here you see a lot of, at 4:10 to 4:20, 10 minutes, the stock has been going down so badly. Then it has been going so up, and then it means there is volatility. This is because the people, they change their mind, okay, and there is a lot of volatility. But at the end, the stock is still going 9.37%. Okay, so you see that. Now you can change, for example, you can see others. Some are very, very important. Some. So Align Technology, it's at 4 p.m. and they say 1.15. So ALGN, okay, how much it lost? It at 4 o'clock they say the information, and at 4:10, okay, the stock has been going $15, which is 6.99, and then it goes up afterwards, because the people, when they sell short, they buy back. Okay, so these are some examples, and you can check whatever stock you like, or you can search for the stocks, but understand that we have a lot. We have a lot. That's why some people, they can't go everywhere, so they will try to see 1 or 2 or 3 stocks only, because it's too much. See how many stocks we have. So see what it says here. 6 hours. See what the stupid people say. Apple barely beats on earnings. iPhone sales decline. How can we have a gap up and the earnings are not good? You see that? You see that having good earnings or bad earnings, it doesn't mean that we have a gap up or a gap down. So this is just for the information. So if you are looking for stocks to buy to do a day trade, then let's say today, Wednesday, we have Facebook. Tomorrow we have 1:30. So you can find where is you can find FB, Facebook. Okay, so Facebook is today. It means tomorrow, and the EPS is 2.19. Okay, 2.19, and here they show you the reported EPS and the surprise. It means the analysts say that the EPS should be 1.47, but Facebook has said 1.76, so the surprise is 1973. It means that things go well for Facebook. And it depends here, sometimes down, sometimes up, depending on the thing. So if you are looking for something, you should always follow. Okay, you should always follow these things. AT&T, this is before market open for tomorrow. So this is in general how you find But understand that we have thousands and thousands of stocks, of companies that they give their earnings, and sometimes there is gap up, sometimes there is no, sometimes there is gap down. So it depends. So it's very, very hard to predict. And this is the stock market. It's not easy to predict things. So you should just have what we call, you should have a commitment to do something, and you know your risk. Okay? Now, so so we have a question, Bassan. Can you buy or short a whole index any day, like day trading? Yes, but understand, Bassan, you short the index by its ETF. Okay? You say buying or shorting a whole index becomes more safe. Now, what do you mean by more safe? I will just show you something. Okay? I will show you something about the index and ETF because I want to make sure you understand this. Okay? So let's go to the explanation again, and I will explain. Okay? Now, let's see. Just to make sure you understand the difference. Okay, let's take Dow Jones. This is, I always give this example because it's very simple and all the people know Dow Jones. Dow Jones index, you can't buy the index itself because the index, you can't buy it because it is out of the reach of buying and selling. But this index, it has something that tracks this index, which is called DIA. This is an ETF, and an ETF is like a stock. It's like a stock. You can go long and you can sell short. It's like a stock. Now, indexes in general are heavy. It means they give you the average. They give you the average. If almost all the stocks are doing well, the index will be doing very, very well. If the average of all the stocks are doing bad, the index will. But it is like a stock. It is an ETF. So you, for example, Bassan, let's say you want to buy Dow Jones index. You go to DIA. Now, I will show you the three that I always show in my channel. I will show you this. Okay. Let's show you the chart. Okay, look, Bassan, I will try just to explain you this, and then I read what you have written. Okay, so let's do. Okay, let's do. If we can see this, I want just to make sure you see the price. Okay. I think we are not getting to the chart. I don't know why, but let's see. Let's go. Let's go to see this. I want just to make to see the numbers, if we can have them, because I don't know. Yes. Okay. Yes, I didn't see right now. I don't see. If we can get them, no problem. I will just explain what's going on. That's it. Yes. Okay. I think I can't manage to show you all the numbers, but it's okay. Now, look at this thing. So here we have the DIA. So this is Dow Jones ETF. So the stock is $245. Sorry for the chart. I don't know how to make it to get it right. But Dow Jones, it is now 245. So if you want to buy the index, you can buy the Dow Jones. If you want to buy S&P 500, you can buy SPY, which is 263. If you want to buy Russell 2000, you can buy the IWM. Well, we have a lot, but this is from iShares, IWM, which is $146. Okay? So these are the ETFs, okay, that you can buy, but there are hundreds and thousands of ETFs. There are a lot. And they are making more and more and more ETFs because they make money from these ETFs. Okay? They make money. The companies that, for example, iShares family is making a lot of ETFs about sectors, about industries, about so on. Okay? So this is just to understand what's going on. So let's see what you have written. Okay? You said, I mean, when you buy the index is going up, you don't have to fight with, suppose one stock you bought and it's going opposite and the index. Yes, but listen. If you want less risk but not safe, you buy the index. Okay? I will explain to you this. I have explained before, I don't know, in more videos, but I will explain it to you now. And then this is the last thing I will explain before we end this session. So I will explain to you this. Okay? So now this is the Dow Jones. Okay? Just an example, okay? This is the Dow Jones. What it is doing now. It was going up, then it go down, then it go up again, okay? Now this is the index. What is it, the index of Dow Jones? DIA. It is 30 stocks average. Okay? 30 stocks. You add them together and you divide by 30, you will find the average. Let's say it is $244. This is the average. Okay. Understand that it is not safe because you are doing a trade. or you are investing in this ETF. This it is not safe. Don't say it is safe. It is not safe because you are carrying an investment or doing a trade. It means you can make money, and you can lose money. So it's the same. But when you make money, you make less. And when you lose less. This is about the risk. People who like ETFs, they don't want to make a lot of money. They don't want to lose a lot of money. If it is your idea, you can do that. But this is in normal years. But in 2008, ETFs has lost 50%, and so it is not safe at all. 50% in 2008 when we have the crisis, when we have the bear market of 2008. So don't tell yourself that it is safe. There is no safe thing in the market. Now, what about, for example, stocks? Stocks in the Dow Jones, for example, you find a stock is doing the same as the index, like this. This is number one. Number one. You find a stock, number two, it is doing more here. So it is making more money. This is the stock, it is here. And the ETF, this is the ETF. This is the average because you get the average here. But this stock is doing more. So if you have bought this stock, you will make more money. And sometimes it is a lot of money. That's why Warren Buffett, he doesn't buy ETFs. Because ETFs, you are obliged to have these 30 stocks. For example, for you, there are stocks that are doing bad. But still they are there, so that's why the ETF is low. This is number two. The number three is stocks that are doing worse. This is number three. It means if you buy this stock, you lose a lot of money. I will give you an example. GE. GE was 32. Now I think it's 15 or 14. So it lost 50% of its money in 1 year or two. So if you bought GE, you will find yourself losing a lot of money. So all this has to do with you. What do you want? Do you want to make more risk and more money and more loss? If you buy stocks, you can have three choices. Either you lose a lot of money, or you make like the ETF, or you make more money. Okay? So you should have in mind that you have these three. But understand that an ETF is always average. Always think about the average in your mind, that it is the average of the market. If this stock has gone 50% up, this average, let's say it makes 15%. So this stock, if you have bought this stock, you have made a lot of money. But here, with the average ETF, you have bought 15% only. Now, if you bought not the right stock, let's say you lose 20% here, or 30% or 40%. So you lose a lot than the average. So if you are looking to have less money, less losing money, less making money, you choose ETFs. And ETFs, you can find sectors, you can find industries. There are a lot. Whatever you want to track, you can track even gold, you can track futures, you can track currency. Whatever you want, you find it. Okay? So that is the deal. So this is in general about Basan, about what I explained. And we are at the end of this session. So thank you very much for watching. And I will be here tomorrow also at the same time. So thank you very much for watching. And see you next time. Thank you very much.